It's a very green screen with gainers far outnumbering the losers. Realty, metals and autos lead the charge while healthcare and FMCG lag. Mid-caps outperform.
Canfin Homes slides after its CEO resigns. The move comes as a surprise given his clarification to CNBC TV18 in May that he would serve his full term till September 2024. Analysts see uncertainty as an overhang.
RBI sources tell CNBC TV18 that there is no reason for non-bank banks to issue credit cards at present. This is a dampener for non-banks that presently distribute credit cards of banks.
Pharma gains on approval to launch a 2,000 crore insecticide. Bombay Dyeing jumps on its rights issue proposal and advanced enzymes gains after its promoters offload stake to a leading private fund.
Good afternoon. Welcome to Halftime Report. I'm Sonia and with me are Ekta Batra and Mangalam Malu. Well, things have looked so good today. It's a rollicking market that we have on our screen. Not once have we seen any form of profit taking, and ahead of the big event, which is the two-day Fed policy that begins today, the market is in firm fettle as it has been through the course of the last many days. Bulletproof Indian markets, and no feathers have been ruffled up until now.
Hi Sonia, hi Mangalam. Yes, absolutely no feathers have been ruffled, and I think the street is just shrugging off anything that the Fed might throw up. 75 basis points or 100 basis points. We were just hearing a bunch of experts say that there is so much optimism towards the Indian markets. That decoupled word has been mentioned multiple times in the past couple of weeks. And not to mention that a lot of the experts now consider that 75 basis points in developed markets is almost like a 25 basis points hike. So hence, maybe there is some kind of expectation that yes, it would be 75 basis points, but maybe that would be a top off in terms of hikes.
I take that point. The important part is that when on bad days we don't fall as much, and on good days we rise more than all the others. And that's how it's taken place. Even indices or sectors which are not doing too well earlier are now coming to the party. Something like a TCS, which has moved to the high point of trade. So the IT sector is doing well after a drubbing that it's seen all of this year, and all the other indices are virtually near their all-time high. So it's just a matter of time whether we go ahead and cross that 18,100 resistance that we had earlier or not. But let's talk about an interesting theme that the world is going to talk about soon enough, and this is with regards to a theme coming in from India itself. Internet-led lead research at JM Financial Institutional Securities. Sachin Dixit joins us now on his latest report on ONDC. What basically ONDC is like a UPI movement for all the e-commerce players. Currently, what you have is a large number of sellers and buyers on specific platforms. What the ONDC will do is move away from the platform-led network and go to a network-based application, which a lot of people will use, democratize e-commerce, so to say. The question is whether it is a disruptor or whether it is evolution going forward. Sachin,
so one sec, just for the benefit of our viewer, right? So an ONDC is basically if I'm a consumer and I want to either book a cab or book a meal or book a gift for someone, I don't have to do it on separate apps. I can just do it on one common platform. Is that the right way to look at it?
No, that's not the right way to perhaps the right way to look at it is that, say for instance, you are a seller and you have a listing on Amazon, Flipkart or any of these platforms. Then what happens is that every time you make that sale, you sell it only on Amazon or you sell it only on Flipkart, etc. ONDC will make it like a network where you upload your details on that network, and Amazon, Flipkart and all these other players will just upload all that data from that network and put it on their platforms. So what happens
So your product is accessible across
all platforms.
So you have more sellability of
You have more sellability. You don't have to give the commissions to all those platforms, and you have access to the data as well. Who's buying it? What kind of people? Currently, all this data is by these platforms as well. I mean, think of it as UPI.
It's like an aggregator at the highest level. It's a marketplace for marketplaces. I think that's the way to.
I mean, it's a network. I mean, let's
ask
Sachin. Sachin, can you explain it to us like we're five?
Sure. Yeah, so Mangalam, basically overall, I think on ONDC, the view largely remains that it's not a wallet, it's not a app like say UPI was not. Similarly, ONDC is not a platform. This is more like a digital protocol. These are digital rails which are basically enabling interoperability across platforms. So no matter where the buyer is, no matter where the seller is, as long as everyone is onboarded on ONDC, they have access to each other. So that's how the transaction can evolve going forward. Overall, it's basically a well-intentioned initiative by the government in order to democratize e-commerce, just like UPI democratized digital payments. And there's valid reason to it too, right? If you look at overall retail industry in India, and see almost 70% coming from food and grocery in the overall retail. While if you do look at the like-to-like in terms of the online or e-commerce platforms, almost 80% comes just from electronics and apparel. While we do understand these are large ticket items which people might be buying online, but there is obviously a sizable portion of our population that has been left out of the e-commerce revolution. So effectively what ONDC is doing, ONDC is giving all of these players who were initially left out a chance to become a part of the e-commerce journey that India is going through. Today sitting at almost like 5 to 7% sort of digital penetration in retail. This number can easily go up towards like almost 20% over the next 5 to 7 years, depending on how ONDC evolves and how successful the initiative is.
So Sachin, let's break this down in terms of what this means for companies probably under your coverage. When ONDC is launched, what would it mean for a Nykaa?
So roughly, I think it will vary for company by company. I think what actually ends up happening is there are obviously these walled gardens that companies have created. Whether it's Nykaa, whether it's Amazon, whether it's Flipkart, I think it's true for everyone. Within these walled gardens, there is some sort of a specialized retail that is happening, and then there's a generic retail that is happening. Interestingly, for a platform like Nykaa, it's a very specialized retail platform. It's driven by content. It's driven by more than just a transaction platform, right? If you look at even the user behavior on Nykaa, people don't go to Nykaa just to do a single transaction. People are spending time on Nykaa platforms even outside the transaction journey that they are doing. So effectively, I believe for a specialized retail sort of a platform like Nykaa, while a bunch of the users might still prefer sticking to the walled garden sort of an ecosystem, compared to ONDC, wherein everything is being shown on the platform on which the consumer might be. But in the best case scenario, let's assume, say, where Nykaa becomes a part of ONDC, right? How does it evolve going forward for Nykaa? Effectively, there is a larger customer base that Nykaa has access to, right? Today, Nykaa has something like a 8 to 9 million odd beauty transacting shoppers on the platform. And overall digital shoppers in India are roughly, say, 180, 200 odd million, depending on whose estimates you are looking at. So effectively, there is a large digital shopper base that is not on Nykaa today. We can obviously factor that out maybe by gender, by the income criteria, etc. But still, there's a large digital shopper base which Nykaa has the potential to onboard, which it does not. In case Nykaa becomes a participant on ONDC, Nykaa now has access to all these digital shoppers. So effectively, they do not need to spend money on acquiring these customers to their own platform. So in that sense, ONDC also becomes a highly capital efficient model. Like not every platform needs to acquire all the buyers. Not every platform needs to acquire all the sellers. People can cross leverage each other's strengths.
I understand that ONDC is still in a nascent stage, right? There's a pilot program only across about 50 cities or so. How long do you think it could take for a complete rollout?
I think it's going to take time because effectively there is a lot of operational complexity involved when you talk of ONDC. Say, unlike UPI, where there was only one SKU, which was cash that was being used, there was no quality issues, there were no return problems. So that is, ONDC is likely to be much more complicated. So how I think, and it's basis media reports only, largely what we are hearing is that 2 cities will go live probably by end of September. And after that, the government has plans for rapid expansion. But it's going to be a function of how well the adoption happens, how well the platform comes out prepared for all the operational problems it's likely to face. So that rollout, I think, will depend on how prepared the platform is when it comes up. And it might be more gradual than rapid.
And that is exactly my final question to you, Sachin. You know that there are a lot of ifs and buts here. If it does not generate the kind of traction everyone is expecting it to generate, then maybe everyone will go back to the current dominant players. So the idea of democratizing e-commerce will perhaps, not be as successful at execution level as it is at the thought process level. The second part is that, even though we will have smaller players joining the ONDC, chances are that they might get marginalized. And where does the buck stop as a customer? If I buy it off someone who's on the ONDC platform but buys it off, say, something like an Amazon, a substandard product who is answerable. So those are a couple of problems, right?
So there are certainly going to be issues. I think recently itself there has been talk of a third party becoming the online dispute resolution mechanism for ONDC. So those sort of checks and balances are being put into place. But in terms of the marginalization of a local retailer or a local entrepreneur, I think there is more that might be needed. In the current shape of ONDC that we understand, effectively, if everyone comes on board, let's say I'm a shopper and I go to a ONDC buyer side app and I see listings from a major brand. Let's say I need to buy a washing machine. I see the brand itself being listed. I also see Amazon, Flipkart being listed, and I also see a local retailer being listed. Most likely I'll go with the first three options rather than with the fourth option, right? So empowering that local retailer, I think a lot more needs to happen. Obviously, it's much simpler to do in food and grocery categories, where the larger brands or the larger platforms might not be as dominant. But even there, I think there will be things that need to be solved for.
Okay, all right, Sachin. Well, this deserves a much longer conversation, but we've completely run out of time. Thanks very much for joining in and
shamelessly plug the Mad About Markets episode that we've done on ONDC. You said it deserves a much longer conversation. Perhaps you can go ahead, get some more details on what ONDC is, because we have the ONDC chairperson himself, Mr. Koshi, joining us on that show.
That'll be a great episode to watch, and
that has happened, so you can catch it on YouTube or in
so we'll wait for
channels.
You to replug it on your Twitter. That's where we can find it for all our viewers. We'll take a short break now, but up next we'll be discussing another big theme which is emerging, which is D2C. Latika Chopra of JP Morgan India, who's joining in from the JP Morgan India Investor Summit, will discuss the rise of D2C brands, especially in the beauty and personal care segment. Stay tuned.
Welcome back. Before the break, we were talking about the ONDC network and the possibilities that India's internet business can have. And let's continue that by talking about another space where we're putting, the spotlight on D2C in particular, which is direct to consumer. The consumer sector, according to JP Morgan, beauty and personal care segments are growing market share fragment, and we are seeing some fragmentation in select categories as well. To discuss this and more, we are joined by a rare voice. Latika Chopra, who's the Executive Director, Consumer Research at JP Morgan, joins us from the sidelines of JP Morgan India Investor Summit. Latika, thank you so much for joining in. And here's, the first question. Everyone's talking about how big D2C or direct to consumer happened or became during the pandemic. Post-pandemic, these companies are facing scalability challenges. Post-pandemic, these companies are facing, higher consumer acquisition costs as well. So does that mean the ball in the FMCG space still lies in the court of the larger players and not these smaller disruptors?
Hi, thank you everyone for having me today. So clearly, D2C is a trend which is going to, it's going to remain. It's a fairly structural trend which is going to stay with us, I think, for a very long time. Clearly, we saw a lot of disruption during pandemic on back of this. But one has to not forget the part that D2C brands basically are challenging the whole status quo, right? They're challenging the way incumbents have typically thought about the beauty and personal care category. They have actually come out with figuring out consumer niches. They have basically following a lot of data-backed decisions on marketing, how to reach a consumer base in a very targeted manner. So I think some of the new trends that they have started, some of the new practices and approaches that they have started towards consumers are not going to go away. Rather, we believe incumbents actually got the wake-up call, and they are actually also approaching the new target consumer segments in a similar manner. So whether you see incumbents following up a lot more on the online piece, how they're increasing their e-commerce salience, about 2-3 years ago, for most companies, this was about, 4-5% of their revenue base. Now it's more like, 8 to 10% in most cases. And I guess I've never heard so much focus on innovation intensity, reducing the time to put out a new product into the market. And this is all driving a lot more consumer fragmentation. So I don't think the D2C theme is going away. But yes, the D2C brands have to scale them. And in order to scale beyond the whole online piece, they have to step into more offline space, so they also have to learn a little bit from more on traditional channels, how to adapt their product base to that. And of course, there was an easy money which definitely helped them. They have to be now more watchful about the profitability aspect of it. And we are seeing D2C brands incrementally trying to do so. Clearly, compared to food, I think beauty and personal care kind of scores better. It has better gross margins. It is able to cover the cost of delivery better. But clearly, things are not one way this time. And I guess both D2C companies and incumbents will coexist. They will continue to coexist. Rather, we need to see what it leads to. So, whether there's more consolidation in the space, we're already seeing that. We are seeing...
Sure. Latika, I just wanted to interrupt you because we are a little bit, on a time schedule. Just wanted to understand that, when you're talking about your regular FMCG companies which are listed, how much of a theme will M&A be, according to you, when it comes to D2C brands? Do you expect them to get more aggressive to get them into their portfolios? Is that a theme that we could probably see play out?
I think it depends actually on what kind of attributes they really want to bring. Is it the technology that they want to bring? Is it the, is it the consumer technology aspect that they want to bring in? It is what they want to achieve. At times, you have to appreciate the fact that a lot of incumbents work with very scaled up brands, right? So they're not very used to working with brands which are, 200, 300 crores in a turnover, right? They typically try to work with, 500 crore plus kind of brands. So, and clearly, there is a speed to innovation. There is a speed to come out with new concepts, trials with the consumers. So we do think that incumbents will be, looking at inorganic growth. They might be more selective about it. We have few companies who have acquired a couple of D2C brands, but they have tried to keep them very separate, from the running of those operations from their regular business. So I guess we'll see more action definitely here. But at the same time, I would say that companies are also building their own organic, D2C brands. Rather, there are a lot of e-commerce first launches that are happening on, from learnings that they are seeing from these new age brands. So I think it's going to happen both ways.
It's very interesting, right? Because I know for a fact, at least, personally, all of us millennials here and even Gen Z, a lot of our consumer spending decisions are affected by social commerce. No two ways about that. And that just brings us to the question that are these D2C brands going to actually disrupt some of the traditional brands? I mean, in your report, you do say that names like Marico, Dabur, Godrej Consumer are relatively unaffected by this disruption. But how can you be so confident? Don't you think that they sort of need to get their act together because a lot of the spending decisions are affected by social commerce now?
Okay, so I'll refrain from making specific comments on the companies, but let me put it this way, not every category is going to behave in the same manner, right? So I think the categories which are more fast growing, which are very nascent, where you see, a lot more action could be possible. There are a lot of unmet demands, needs of the consumers. I guess those are the categories where we're seeing a lot of fragmentation, so a category like skincare, for example, a lot of fragmentation, incumbents have been losing market share. They were sitting on very hefty market shares. They've been losing market share. But some of the more traditional categories, where, probably penetration levels are already very high, there is not very exciting growth prospects from mid to long-term prospects are probably the ones which are relatively more insulated. So I think every category will behave very differently. But yes, I think D2C brands and a lot of new age brands, even from the incumbents, will probably keep everybody on their toes. And, competitive landscape is definitely evolving at a very rapid pace. And it's not that incumbents are going to lose market share, rather honestly, over the whole period of pandemic and recent years, we've actually seen the bigger brands actually getting bigger because of various nuances of how the consumption landscape has been. But definitely we would see more investments, more strategic priorities being given towards innovation, R&D, distribution, participating in different channels, in a very calibrated, prudent manner, to stay ahead of the curve. And we will see more fragmentation because that's the way consumer is behaving, right? There's this whole talk about personalized consumer access. And that's the whole thing which is behind, a higher competitive intensity as well.
Take that point, and personalization was a big mega trend that HUL spoke about in their last trend setting PowerPoint presentation that they made to analysts as well. Latika, always a pleasure speaking with you. This is this is a space that we will keep continuing to track with regards to everything that takes place out here. And I like the fact that you said D2C actually went ahead and gave a bit of a jolt to all the traditional FMCG companies. So now that they've figured out that, okay, this is something that is working, what they do with it is extremely important, because, what the traditional FMCG companies have is offline presence and a lot of cash. What the D2C players have is brand presence. So is there a case for some synergies out there, more M&A? Or not is something we'll watch
Actually, I was just thinking, the last 5 purchases that I made was largely because of social commerce influence. And I don't know if that's a good thing or a bad thing, but that just speaks of the trend that this generation perhaps
Not to mention, over 600 D2C brands in India, $100 billion market
it's
size,
$100 billion
probably
market.
by
Yes.
FY25 is what is estimated for the entire market. But nonetheless,
am I allowed to shamelessly plug another Mad About Markets episode?
You can just be plugged because everything you plug is shameless now. Okay, well, let's move on. And let's thank Latika for joining us and speaking to us from the JP Morgan conference. Let's slip into a quick break. When we come back, we have a guest joining us, the JB Chemicals. The management will be with us, Nikhil Chopra, who's the CEO of the company, will tell us more about their business. Stay tuned.
Welcome back. Well, holding steady for the markets at this point in time. Mid-cap index is up around 2%. So let's discuss business outlook with another company. Nikhil Chopra, the CEO and whole-time director of JB Chemicals, joins in now from the sidelines of the Motilal Oswal 18th Annual Global Investor Conference. Nikhil, hi. Good to see you on the show. We were discussing D2C brands. And one of your most popular brands is Rantac, which is basically the antacid drug ranitidine. It just exited the NLEM. It's not a part of the essential list of medicines in India anymore. So that means that the prices will not be capped. It's one of your more successful drugs, 40% market share within that space. Tell us what this means in terms of pricing for you all.
First of all, thank you, Ekta, for having me on the show. I'm here from Motilal Oswal conference at Grand Hyatt, Mumbai. About Rantac as a brand, we feel proud that Indian consumers' experience of 4 decades has made Rantac as a brand as big as 200 crores in Indian market. And overall, Rantac as a brand is not one SKU, but we have 10 different SKUs in Rantac, which is a combination of traditional Rantac 150 milligram tablet and Rantac injection, which were under price control, but other SKUs like Rantac OD300, which is an incremental innovation, Rantac syrup, where pediatricians are a big fan of the product for their patients who are suffering from GI problems, the pediatric patients. So overall, if you look at from a perspective of WPI, which comes every year, this year WPI was around 10%, so we could take a 10% price hike. It is a 1 rupees 20 paisa tablet of Rantac 150 milligram. And 4 decades of experience from GP to the specialist. So we continue to market this product in the clinic of healthcare professionals, and we feel proud that this is a household name in a country like India.
Okay, Nikhil, welcome to the show. Thanks a lot for joining in. So what kind of growth do you think you can eke out from this product over, say, the next 6 to 12 months? And how would that reflect in your own earnings?
So overall, if you look at, we see Rentec, some parts of SKU may be seasonal dependent. As last year, Rentec was a part of COVID regimen in Q1. So we could scale out good revenues and good growth. But this year it has subsided down. Low double digit would be the growth that I would talk about in the coming time, in next couple of years, which will be a mix of Rentec traditional 150 milligram tablet. But we, for example, a product like Rentec syrup, which today is a 50 crore brand for us, we see next 2, 3 years, 4 years, this can be 100 crore revenue where we have good margins. So overall, from a perspective of where we stand as a Rentec, as a product, basically quality medicine at affordable price and access to all Indian population. That is what I can say at this moment of time for Rentec as a brand.
Okay, strong brand, quality medicines at affordable price, good growth seeing, that's a medley of opportunities. But talking about medley of opportunities, you know, there were reports that you are in the race for medley pharma as well. You haven't shied away from inorganic acquisitions in the past, but is this something that you are eyeing currently?
So right now we are not in the race. That is what I can talk about medley. But as a company, we continue to evaluate assets as and when they come on the table, and happy to share that we are one of the company that could at least close 3 acquisitions, starting with what we acquired Sensex as a company in the world of probiotic, which is a growing market in India, close to 2,000 crore market. For pediatric and adult probiotic. Equally, what we acquired from Novartis as a brand in the field of heart failure, Azmada, sacubitril valsartan, which according to me, heart failure is going to be a disease of next decade. And we acquired 4 pediatric products from Dr. Reddy, where we see huge opportunity. So we have invested close to 1,100 crores, and we continue to evaluate assets which are synergistic to the play that we want to work on and win. And equally, if we think that we can turn around the asset which we acquire, that is what we keep in mind. But also, of course, what we keep in mind is that we don't want to chase any mad valuation, and we don't want to put any stress on our balance sheet. That is where we stand from an inorganic opportunity.
Okay, so
but also, what I would like to share at this moment of, yeah.
Go ahead, Nikhil.
Yes. So, as you look us from as a company perspective, what I wanted to also talk about, and happy to report that if you look at August IMS reporting, we are the fastest growing company with a MAT growth of 20% as compared to market growth of 8%, and equally for the month, the market grew at 10% and we grew at a pace of 20%. So we will continue to outpace market with the combination of organic growth with all our 4 or 5 big brands, equally the inorganic assets that we have acquired, and also for the first time last year we could launch around 15 new products in the field of respiratory, cardiology, nephrology,
sure.
Pediatrics in the
Nikhil, that point is taken that
country,
you're very successful in the Indian market. You have very successful brands besides Rantac, such as Metrogyl, which is another household brand. But I just wanted to understand, Nikhil, you know, before we run short of time, your exposure to Russia, you know, and what is happening in Europe. Can you give us a sense in terms of what the export business is doing? What are the kind of headwinds you're facing for Russia? Because despite all of, you know, the trepidation, you are still looking to launch, I think, products with Reckitt. I think it's Strepsils you might be looking to expand in the Russian market.
Yeah. So Russia for us is a $20 million prescription business and around $10 million consumer business. And we continue to do that business, and receivables are on time. Russia is a small part of our international business, but Ekta, just to share with you, we had one of the best Q1 for our international business, and major part of that success was a part of business that we do in the world of CDMO, where you just shared Reckitt as a partner that we work with, but our number 1 partner is Procter & Gamble, Innova, Adcock in South Africa, and now Reckitt in some parts of Australia, New Zealand, Canada, and we are extending our partnership in Russia also, and that business is scaling up in terms of giving us revenues So we showed an exponential growth of 30% growth in our international business, and the order book also is robust for the coming 2 quarters.
Okay.
So overall, just to share with you, all guns are firing at the right time for us,
Sure.
and we continue to at least do the right things for all our business units across the globe.
Okay, when you said Rantac is like a household name, right? I mean, that's great for your business, not so much for people living in those households. I mean, the amount of acidity patients have definitely gone up multifold over the last many years. But I mean, great for you guys. I wanted to ask you a little bit more about the India business. Can you give us some numbers? I think in the quarter gone by, you touched that 400 crore figure on the India business.
Yeah.
On a quarterly run rate basis, can you do better than that? What would the average be?
So obviously, the way we look at Indian market, combination of organic growth for our brands, the acquisitions that we have done, all the 3 I shared in detail, and equally the new introduction, we see overall the trajectory going up northwards, and if the market is growing at around 10 to 12%, we should show a healthy growth around 18 to 20%. And we will continue to up the trajectory on the benchmark that we have achieved, new highs that we have achieved of 400 crores. We should be looking at in terms of quarter to quarter, how do we touch new peaks? Because overall, the entire infrastructure which is working on the ground for us, which are now 2,100 medical reps, and we are covering close to 400,000 doctors, and now we have widened our portfolio more in the space of chronic, and new introductions in the space of respiratory and pediatrics is only helping us to derive new prescriptions. And just to share with you, Ekta, now conceptually we may be a 22nd, 23rd ranked company in terms of value, but in terms of prescriptions, we are 15th ranked company in India with brands like Rantac, which I shared, Metrogyl, and equally Sporolac in the world of probiotic. So this all is putting us in a spotlight of around 1.5 crore prescriptions every month. That is what we are touching.
All right.
So we're going to wrap it up on that note. Pleasure speaking with you. Thanks very much for joining in and speaking with us. So that's JB Chemicals on the sidelines of the Motilal conference. On that note, I'm also going to plug in the medicine box because
yes, please.
We've spoken quite comprehensively on ranitidine. But nonetheless, we'll take a short break on that note. We'll put the focus on Infosys and HCL Tech from the IT space, which are trading in the green as brokerages sound positive. Stay tuned.
What a terrific rally this is turning out to be. Just take a look at the market. The Sensex has now once again scaled that 60,000 mark. It's up and away for the Nifty. And so many stocks are sitting at fresh highs as we speak. Ambuja Cement, ITC, Bharti, TVS Motor, Eicher Motors, Maruti. The list is pretty endless and looking very pretty now on the screen. But let's get a focus on the IT space because it has been one sector that's underperforming. Reema's here to talk about Infosys and HCL Tech. Brokerages sound positive on the stock, so let's find out more. Reema.
Thanks so much for that. So let me start with Infosys, where Citi has come out with a note post their meeting with the management at their recent conference. And the key takeaway is that the company maintains its full-year guidance despite the macro uncertainty. So on the top line, Infosys is confident about, delivering a 14 to 16% constant currency revenue growth. And even on margins, the company says that margins, as they had guided in Q1, will be at the lower end of 21 to 23% for the full year. When it comes to the near-term demand outlook, which is where the concerns are out of fears of a potential recession in the United States and probably one that we're currently in Europe, the company says that we've seen softness in the mortgage business, which comes as a part of the BFSI business, but the company does not tell you how much of their revenues depends on mortgages. But because of rising interest rate, mortgage volumes have come down, because of which the mortgage business is a bit subdued, and retailers too have been impacted due to the very high inflation. The pace of decision making has slowed down for a couple of clients, and a few clients are now focusing more on cost cutting. So they brought down their perhaps discretionary spending to focus more on cost takeouts in terms of projects. That said, the long-term demand continues to remain very intact. Discussions are still on about a potential higher pricing. Attrition is moderated, but still remains at very elevated level. Let me quickly move on now to HCL Technology, where Kotak Institutional Equities has come out with a report. Now, they're bullish on HCL Technology. They're saying the stock looks very attractive. And the thesis is that the application business of HCL Technology, which is about a third of HCL Tech's overall revenues, has been growing very well. It's been seeing a growth of high teens and has emerged as a key growth driver. And the company aspires to be a big challenger in this space versus the other big players. Also, Kotak believes that HCL Tech can close in the gap versus peers. In FY23, margin pressures are there, but it's adequately baked into the price, and valuations at 16 times forward multiple, according to Kotak, looks attractive for HCL Technology. Back to you.
All right, Rima, thanks a lot for that. With that, we'll step into a short break. On the other side, we'll keep an eye away from the equity markets, which are soaring right now. We'll let them be and talk about the commodity space. Manisha Gupta joins in.
Welcome back to Halftime Report. Joining us on the show now is Atul Ganatra. He's President of Cotton Association of India. Mr. Ganatra, hi, thank you so much for taking time. I want to start first with the cotton prices itself, because we've come down sharply, nearly 35% off from the current year's highs. And with the crop looking good and the arrivals now starting into the market, are you looking at prices going down further from here?
Good afternoon, Manisha ji. Yes, you are correct. Cotton prices has already corrected by 30-35% from 1,05,000 to 75,000. There are many reasons for prices has reduced, and I personally feel further there is a 10,000 rupees scope of further price to reduce. There are 3-4 reasons, Manisha ji. Number one is demand is very slow. Number two, 50% spinning mills are closed, so consumption of the cotton per month has come down to 12 to 14 lakh bales from the top 30 lakh bales per month. Number three, Indian new crop conditions are very good and sowing has increased by 8%, so we are expecting better crop. So once arrivals will pick up, already started arrivals, once it will pick up, prices will be further reduced. And number four, main thing is even international prices has started reducing. The ICE future market, which was 110 cents before 15 days, is today 95 cents. So there also 15% price has reduced. And moreover, if we see the international price, ICE December is trading at 95 cents, which is around 60,000 rupees per candy.
Right.
And our Indian prices are 75,000 as on today. So our prices are still 15,000 rupees higher than international prices.
All right.
So prices, as you said, are likely to come down further. Ji, Manisha ji.
Yeah. So, Mr. Ganatra, the second important question then is that are you looking at the demand now picking up? And I mean, as you said, the mills had shut down because the prices were so high, but prices have come off now. The festival demand is upon us. Are you looking at that demand picking up at all, or is it too late because we have Diwali in a month now? I mean, that demand should have come into the markets, would you say?
Yeah, you see, already the festival season demand was very good, but the mills who were having stock, they have sold the yarn and cloth for the festival demand. So festival demand, whatever the buying was there, it is almost over now. But new demand has to come from the international market. See, Manisha ji, we are depend on exports. If our total production of cotton yarn and cloth, we are consuming only 70% in India and 30% we have to export. So we are dependent on export. But I personally feel that once price will be reduced another 10,000 rupees per candy, the demand of cotton yarn and cloth, every demand will come from the entire world market. I think from the mid-October, demand will pick up from the world market for Indian cotton and cotton yarn and cloth. Yes, Manisha ji.
So just coming to the festival demand itself, you're saying that whatever demand that had to come for the current festivities, including Diwali, is already done by the manufacturers and textile industry into the Indian market. The next demand, I'm assuming, is going to be the Christmas and the New Year demand, which you're expecting from the international markets. So what is the number in sense of exports now when you look at Indian textile, apparel and cotton? And what is the domestic demand looking like? If you could compare it to the last year and the expectation going forward.
No, compared to last year in export market, demand is 70% down.
Okay.
But domestic demand is good, and our own consumption for yarn, cloth demand is there. But because our cotton price and cotton yarn price were very high, due to that our cloth market also, cloth people also, they have increased the rate drastically.
Okay.
But once now we will see in coming days, even as you asked me the question, mills will restart. I am hoping that mills will restart from the first week of October. Consumption of the cotton will increase. Production of the cotton will increase. And this is a very good sign for the entire Indian textile value chain. I am seeing the boom period will start from 15th October, and next 1 year it will be very good because the entire world, China buying has been diverted to India. Even Bangladesh buying will divert it to India.
Okay.
So I am looking good demand from 15th October, Manisha ji.
Okay.
All right, Manisha, Atul, thank you so much for joining in and giving us the outlook on the cotton space. Just keep an eye out on the metals sector actually, because there were flashes that came in from the steel ministry saying that the demand for export duty cut on iron ore and steel is being actively studied, and they will get back with a judicious decision on duty revision soon. What we'll do is actually take a short break, come back, focus on those stocks. Welcome back. We were talking about the steel space. Moments ago we had those flashes at the bottom of your screen coming in from the steel minister saying that the demand for export duty cut on iron ore and steel inputs is being actively studied, and this is something that the street was anticipating as well, as there were windfall cuts on the oil and gas space as well. Maybe the street believed that this could come by for the steel sector, the iron ore and steel sector as well, and that's primarily because the commodity prices have cooled off from the top. They've said that they're actively engaging with industry with regards to demand for cuts in import and customs duties, and they will soon take a judicious decision with regards to duty revision itself. They've written to the finance minister with regards to the demand of the industry as well. So is something like that, if something like that does come, it would be a positive for the industry, and that's something that we're seeing in the way these steel stocks have been moving as well, maybe on anticipation of this duty rollback. So those are a bunch of stocks moving, but they're not the only ones which are moving. In fact, we have the entire market which is doing well. We're virtually at the high point of trade, 17,900 plus for the Nifty. Take your leave, come back on the other side. There will be business lunch.